Hi, this is Ashish, and I'm happy to present to you the last edition of this calendar year 2019 of our Alpha Strategist. The theme for this month is polarization, and it's quite apt if you look at what has happened in equity markets as well as bond markets. There are very few select companies which are doing well, which are close to their 52-week highs. In fact, if you look at the performance for this calendar year, Nifty is up close to 10%. Whereas the mid and small cap indices are down -3 as well as -10 respectively. However, if you look at it from the all-time highs, Nifty is closer to the all-time highs, whereas mid and small cap indices are still down 15 to 30% from their all-time highs. So there is a lot of polarization in the market where a large amount of money is chasing few large companies. Similarly, in the bond markets, if you look at few issuers are able to raise money at very reasonable yields. There are about 5 to 6 issuers which are backed by large corporate houses which are able to raise cheap money at and any quantity at close to about 7.25. Whereas a large number of NBFCs as well as corporates are struggling to raise money even at double-digit yields. So essentially what we are witnessing in the market is a flight to safety. In absence of earnings growth in equity markets, and in absence of in the presence of uncertainty in bond markets, money is going to very few issuers and similarly very few stocks. So if you look at the A group scripts are close to 95% of the overall market cap. Similarly, 60% of Nifty is in 10 stocks. This is a classic risk aversion kind of a market. For the calendar year, like I said, Nifty is done close to 10%. The best performer has been gold this year, which has done close to 22% return. The high quality bonds have also fared very well, with gilts doing close to 11% and AAA PSU as well as high quality corporate bonds doing close to 10%. In essence, this is what we've been messaging, that different asset classes perform during different times and different years, and hence you should make a good asset allocation and investment charter the bedrock of your portfolio as the asset class performances keep rotating. As far as the economy is concerned, we did see a very low growth of 4.5% in the last quarter. We believe growth could go lower before a recovery sets in. Corporate tax has definitely helped. Corporate tax cut. We also believe that the government is now taking a lot of measures to revive growth. So they've put out a real estate fund to give last mile funding. They've put out a first loss guarantee fund to enable banks to buy out assets from NBFCs. RBI has followed suit by cutting rates to 5.15% repo, and they've put in about 2 lakh crores in the banking system. The issue clearly is transmission, because banks are extremely conservative at the moment given the past history of defaults. A lot of the non-banking financial companies are finding it difficult to raise money, and hence they are being very conservative when it comes to lending. We believe that this will take a little time to change, and obviously it will change because this kind of extreme risk aversion does not help lending companies, and it does not help growth as well. We believe that you will see more measures in the upcoming budget, which is due end of January. There are talks of personal income tax cut as well as cut in long-term capital gains tax rate to revive sentiment. We always believe that it looks terrible before things revive, and like during boom times we don't know what will prick the bubble. Similarly, during such times we don't know what will lead the recovery. However, it does happen. Cycles play out over time. When it comes to stock markets, valuations are very reasonable in the broader market. If you look at, like I just mentioned, that mid and small cap indices are nowhere close to their all-time highs. There are few stocks which are close to all-time highs. So a broader market valuations are very reasonable, and when growth picks up, you will see decent re-rating across a lot of stocks and sectors. So we believe this is a good time to get invested in equities, in multi-cap strategies, and look at select small and mid-cap strategies. As far as fixed income is concerned, we prefer to be very, very cautious. So hence we believe we should stick to high quality PSU debt funds. However, at the same time, I do recommend holding some liquidity in the debt portfolio through arbitrage funds or ultra short-term funds, because the credit space is becoming very, very interesting, and at some point you will get opportunity to allocate in the credit space, and it could come pretty soon. So hold some firepower, hold some liquidity. You can continue to hold gold. We've been messaging that depending on your portfolio construct, 5 to 10% allocation in gold is a good allocation to have as an insurance to any untoward global event or domestic or delay in domestic recovery. So with that, I wish you a great new year and a prosperous one at that. See you soon in 2020. Thank you very much.